appreciate Henry for coming out and everybody coming out. I know you guys are busy, especially this guy right here. And so, if you want to know why I did it, partially I did it because it's good to kind of do these types of classes and get out there and teach people. But also, the theme of this is what you'll see is I get a lot of the same questions over and over and over and over again. Part of this is to get you guys and whoever may see the video to answer a lot of the same questions that we see over and over. So this is the first of many seminars. We're partnering with the library to do a couple more on different topics. So appreciate you guys being here. Okay, so the key topics, you guys probably can't see all of these. We've got the application, which I can really see. We've got application, we've got income, credit score, assets, sales contract, appraisal, insurance, monthly payment and escrow, and interest rate, and then we're going to get to closing. So the first thing we're going to talk about is the application. There you go. Okay, so application is the first part, and I'm going to pass one around for you guys. So you can see a copy of it. That application is called the 1003. And whether you get a loan in Wyoming or Hawaii or here in Augusta, Georgia, it's going to be the exact same form. It's always the same information, and that provides the framework of the loan. So it's always the same information. It's your name, your credit score, your income, your residential history, 2-year history of employment. Everything in that application has to be verified. There was a time where you could just say, hey, I make this much, I work here, nobody would double check. These days, every single thing has to be double checked and verified. Now, normally it can take between 15 to 60 minutes to get what's called pre-approved. And a lot of people say, hey, I want to get pre-qualified or pre-approved. The difference between a pre-approval and a pre-qualification is huge. So a pre-qualification is just, hey, Matt, how much do you make? Okay, great. And then I pull your credit. And I say, okay, you can theoretically afford $300,000, okay? A full pre-approval is I get your pay stubs, we get your bank statements, we get everything, your tax returns, and there's no reason that loan should not close, okay? So there's a big difference. So a lot of times real estate agents, a lot of times they'll say, hey, before we can show you these houses, we need you to get pre-qualified or pre-approved. That's a letter that we write after we go through this process. So it all starts with the application, which you guys have seen. Income. So now income is the most important part of any loan. It's more important than your credit, it's more important than anything, okay? So now income, in case you don't know what that is how much money you make. All right, so it is your gross income before taxes, not after taxes, it's your gross income. And you have to have a 2-year history for any commissions, any overtime, any bonuses, anything like that. You have to have a 2-year history. And so what happens a lot of time is people will call and they'll say, hey, I make $5 an hour, but with my tips and my bonuses and my overtime, I actually make, $100,000 a year, which is fine, but we have to have a 2-year history. So if you're a waiter, you've got to declare those tips. If you make any type of commission, you have to have a 2-year history. Okay. Income is extremely important. The way that's verified, pay stubs, W-2s, 1099s, tax returns, and in some cases, your bank statements. In the case of a bank statement, that's if you're on Social Security or something like that and you get direct deposits. Lastly, we've got debt to income ratio. Extremely important in getting a loan. So let's say Henry comes into the bank and he says, hey, I want to get a loan. And I say, okay, great. How much you make? And he says $2,000 a month, which Henry, that's probably a slow Tuesday for him. But he says, $2,000 a month. And I say, okay, great. And he says, hey, I've got a $500 car note. I've got a $500 monthly payment loan that I took out. I got a $500 student loan, and then I got a $500 a month little credit card balance here at the library. His debt to income ratio is going to be 100%. Okay, so he's not going to be able to get any loans. That's before he even tries to get a mortgage. He's already at 100%. And so, needless to say, he's not getting anything. So let's say a week later he comes back and he says, hey, I've paid off my credit card, I paid off the car. Now he's going to be at 50% debt to income. And that's before getting a mortgage. So if he pays off the last thing, then he's going to be at 25%. Let's say he has another 25%. The mortgage itself is $500. That will put him again at 50%. So the sweet spot on debt to income ratio is about 41%. So if you're less than 41%, you're not gonna have any problems, generally speaking. If you're over that, it gets a little tricky, especially with a conventional loan or something like that. But I'd approve people at well over 50%, it just really depends. Okay, so credit score. I get so many questions about credit score, it's not even funny. It's not even funny. Every single day, Henry, he gets the questions every day as well. Credit score, that is the mathematical representation of how creditworthy you are. Of how creditworthy you are. Okay, so generally speaking, a credit score is going to go from 300 to 850. So if you have an 850 credit score, is about as high as it goes. 300, I've never seen it. Have you ever seen that before, Henry? 300?
I've seen some close.
388.
Yeah, I've never seen one that low, but I've seen it in the fours easily. So the scores are obtained from 3 bureaus, as you guys probably know. There's Experian, Equifax, TransUnion. Usually a lender is only going to use one of the scores. So they may use the median score, they may use just Equifax, it really just depends. But usually only one is used. And the minimum credit score is going to depend on the lender, type of loan you're getting, a lot of different things. But your credit score is going to impact your interest rate and your insurance rates, which we'll kind of touch on in a second. But one of the things I really want to touch on with credit score is a lot of people kind of have these two beliefs about credit score, which are true but not all the way true. One is that a credit score, it's based on the past, and it's what happened in the past, and that's my credit score. And then the other thing is this number given to you by the man, and hey, this is my credit score, the man gave it to me, and that's where I am. Those are kind of true, but it's not all the way true. So in the sense of based on the past, that is true, because it's based on your credit history. That is what's influencing your credit score today. The past is influencing your credit score today. But really what a credit score is it's a mathematical prediction of your future. So when you have an 850 credit score, what it's saying is, hey, this person, not only are they going to pay off all the debt that they already have, but any debt that you throw at them. It's not just based on the past, it's actually a prediction of the future. It's an algorithm. Okay, so a lot of people kind of think of it as just, oh, it's the past, but it's actually the future. And the second thing about it being the man giving you a credit score, to a degree, that's right, because it is a score that some nerds came up with a long time ago, right? And it affects all of us. But it's based on your information. So it's based on whatever Capital One is telling you, whatever Queensboro's telling you, whatever Kia of Augusta is saying, that is what your credit score is. It's not just determined from nothing. That being said, there's a lot of misinformation on credit reports, so you need to check it frequently. Okay, so this is what credit score is made up of. Predominantly credit history or payment history and outstanding debt. And that's not your cable bill or your rent. It's when you borrow money and you have to pay it back. So it's not anything else. So outstanding debt, your utilization, and we could honestly give a long talk about this, me or Henry, but credit score is huge. A lot of people need to know that. Another thing, one of the questions I get almost all the time is, hey, my Credit Karma said I'm here, my Credit Sesame said I'm here, what's the difference? Or how come my Equifax and my Experian are different? The reason is because the information reporting is not symmetrical. So it's not just this perfect reporting of information. Sometimes TransUnion gets stuff that Equifax didn't get. Sometimes Equifax and Experian get things that TransUnion didn't get, and vice versa. So at least you're having different scores. Also, Credit Karma, excuse me, so credit reporting is a multi-billion-dollar industry, and they want to keep their margins where they need to be, so they're getting cheaper versions of the credit report. And these formulas are not public knowledge, so they're just guessing a lot of the time. All right, so assets. Really important also, but not as important as income and credit. Assets, this is kind of a fancy banker term, but that's your positive liquid net worth, or your collateral, which basically means money in your pocket, or the house that you're gonna buy, okay? Another huge misconception on down payment and get this question so often. People say, well, how much do I need to put down on the house? How much do I need to put down? How much do I need to put down? Sometimes it's nothing. Sometimes it's 20% if you're getting an investment, or sometimes if you're a doctor, you can put zero down. If you're a lawyer, you can put zero down. If you're a firefighter, there's special programs. If you're a bicyclist, they have special things. It just really depends. But most programs require something down. And what a lot of people think in their brain is that down payment is like tribute to the lender, where it's like, okay, how much do I have to put down? All right, cut off my arm, here you go. What it really is it's what you're paying for. So the lender is coming up with everything you're not. And so the analogy I sometimes use with people is it's like going to the grocery store, you get to the checkout, and they say, okay, that's $100, right? And then you say, okay, he's gonna pay for it. And then you walk out and start eating the food. That's kind of what it's like with us, because we're coming up with most of the money as the lender. And so when people think down payment is like the sacrifice, truth is, it's what you're coming up with, right? And so lastly, in all this assets and loan to value, the most important thing to understand is that loan to value represents less risk for the lender. Okay, so if you don't make your payments, then it's less risky if we fronted all the money for you versus you had put maybe 20% down. So that's why it makes it less risky, you get a better. Okay, sales contract. When you buy a house, there's an agreement between the buyer and the seller. Right, I won't get into the minutia of all that, but essentially what it is it's a binding legal agreement between the seller and the buyer. And it has the price, the closing date, all the special stipulations. Sometimes it's counter offers and they say, hey, leave the fridge, but take the washing machine. It can get very, very complicated. But essentially, it's just an agreement with all the terms, okay? In the Augusta area, there's a period where the buyer can sort of kick the tires of the house, so to speak. It's called due diligence. That's when you do all of your inspections and make sure it's the house you actually want to get. And you can pull out of the purchase kind of no harm, no foul. You're not legally bound to the purchase. But in order to do that, you have a deposit called earnest money. In this area, it's about $1,000 if you're buying $200,000, $300,000 house. If you're less than that, it may be $500. It just depends on the contract. Also, the negotiations include how much the seller's paying in closing costs, which are very important. All right, an appraisal. And I actually have a copy of an appraisal for you guys so you can look at it. And I had a sales contract also, if you guys want to take a look at what all these mythical documents are. But an appraisal is a written report of how much the house is worth, okay? And an appraisal report, it has pictures, it has rough blueprints, and some detailed information about the property. But an appraisal is not a home inspection. So a lot of people get that confused. They say, hey, is the appraiser looking for this? Are they looking for that? The appraiser is not looking for defects. They're assigning the house a value. Big difference. And so what they're doing is looking at the market, looking at recent sales, and then comparing those two. So what they'll do is they'll find a house, they'll say, hey, this is a 5-bedroom, 4-bath with a swimming pool. Okay, this is a 5-bedroom, 4-bath with a swimming pool within a mile of each other, sold recently, therefore they're comps. But a 3-bedroom house is not a comp potentially for 6-bedroom and so forth. So they're not the same. Sometimes with government loans, they are doing a little bit more of an inspection. So that's because the government is backing the loan. So they're going to have standards they need the house to be conforming to. All right. Insurance. I never get any calls about insurance. The only time people really care is when you tell them they need to get it, right? I get questions all the time about down payment, credit, income, but insurance is the thing that a lot of people don't think about. And all insurance is the same, it's protection. Hopefully it's the biggest waste of money you ever have, but you have to get it if you're getting a loan and buying a house with a mortgage, right? So PMI. Everybody hates PMI, I don't blame them. PMI, it protects the lender against default. So pick on Phoebe. Let's say Phoebe does not pay her loan and the bank takes it from her. Private mortgage insurance, that's a third party who's going to step in and then they're going to cover some of the loss. So that's transferred to the buyer if you don't put 20% down In some cases, other loans, they'll have it, but then it protects against that. Homeowners insurance, it protects against something happening to the house. So a fire, flood, all that stuff, a tree falling down, and if somebody hurts themselves on your property, then it will protect you in case they try and sue up to a certain amount. Now, flood insurance is usually optional, but if you're in a flood zone, it's not optional. You have to get it. It's set by FEMA. It doesn't matter if you call State Farm, Allstate, the rate's gonna be the same. It's just set by the government. If you decide to get it and you're not in a flood zone, it's usually a lot cheaper. For just kind of context, Houston was not in a flood zone when that huge flood happened, so the losses were pretty bad because nobody had flood insurance, except for the people who just decided to get it. Excuse me. All right. So, title insurance, something that no one has ever heard of. Thank you. All right. Title insurance. No one has ever heard of this, but it's really important. It's part of your closing costs. Title insurance protects against title disputes and liens on the property. So what I actually tell people and all the buyers that I work with, title insurance is actually really protection against the attorney doing a bad job. It's kind of the way it is because they're going to do a title search regardless. So it's basically what a title dispute is let's say that you buy the house and then a year later some long lost relative comes up with a napkin or something, and he says, hey, I actually bought this house 10 years ago, and it's actually mine. It protects you against that. Protects you against a roofer who maybe didn't get paid, he moved in with the house, put a lien on the house, and now they say, well, you own the house now, so the lien's on you. Or even that person didn't pay their taxes, homeowners association dues, all that. So it protects you against those things. The older the home, the more risk. And the newer the home, the less risk. So if you buy a brand new house, one owner, probably no title issues. But if it's a house from 1872, there's probably a lot of owners. Records weren't kept the same way, so it's a little more risk. The last thing is, all these are required, but there's other types of insurance, like mortgage, life insurance. After you buy a house, you get a lot of spam about that. Excuse me, but mortgage life insurance is basically protects in case you die, and then someone has to pay off that loan. Protects against that. Alright, so kind of wrapping up, or getting close to these, monthly payment and escrow. So questions I get a lot is, what's my monthly payment gonna be? Okay, so that's gonna depend on the repayment of the loan, that's called principal, meaning you borrowed $200,000. That's the principal. Okay, it's gonna be made up of your interest, which is the rate at which you borrow the money. So that's principal and interest. But what a lot of people do not consider is that you usually have to have escrow in your account. I've got a little thing that's gonna make it more visual, but escrow is a separate account for your taxes and your insurance. Because at the end of the year or whenever you close, you're gonna have to have that house insured. So let's say that you close today, March 26th, that house will be insured from March 26, 2018 to March 26, 2019. And then State Farm, Allstate, whoever, they're gonna say, hey, we need more premiums to keep this house insured. In which case they're gonna send you a bill for $1,100, $2,000, however many dollars. Lenders don't want borrowers having that risk, so to speak, so they just take care of it themselves. And what they do is they divide it up 12 times, so January, February, March, so on, 12 times for your insurance and your taxes, and every month you pay a little bit instead of having to pay this big bill afterwards. So that's what escrow is. A lot of people don't even think about it, but unless you put 20% down, generally speaking, you're gonna have escrow. So that's gonna add hundreds to your payment every month. And if you have PMI, that's also gonna be a part of your monthly payment. All right, so this is to describe exactly what escrow is. This represents your taxes, this represents your insurance. It's divided up into 12 pieces. Every month you pay a little piece, a little piece, a little piece. The bill comes due and it's paid for. You don't have to pay it yourself, your lender pays for it. And that, again, is to, in theory, prevent the house from going uninsured or getting a lien on it because you didn't pay your taxes. All right, interest rate and term. The bank actually told me to take this slide out, but I just changed it because it contained trigger terms, which we're not allowed to talk about specific rates or anything like that, but obviously a rate is really important to your loan, right? So the loan term is the scheduled length. So usually 15 to 30 years, usually 15 or 30 is what people go with, but most people just go with the 30 year because the payment is lower, which means 360 payments. So if you hold the loan until it's due, that's 360 payments if you do a 30 year. And interest rate is the long-term set price of the loan, so to speak. Now, I get calls so much about interest rate, it's not even funny. I was walking my dog probably about a week ago or something, and I was walking up, and I get a call from someone in Seattle, who I guess is moving here. And he says, hey, how's it going? And I said, hey, it's going good. He said, what's your rate? What's your rate? What's your rate? Just literally just jumps right into it. I was like, oh God, is it a 30 year? Is it a VA? I kind of had to reverse it, engineer it back from him. But interest rate is normally quoted in fractions of 1%, right? And it's usually quoted in eighths. So, and again, I had to take out an actual number and just put X, but X 0.8. And a lot of people want to save money, right? Because you want to get a low rate. And so it's important to realize that rate changes are not the way to save money. The best way to save money is to buy, a cheaper house, buy a more fuel efficient car, things like that. The reason why I say that is because if you hold a loan for 30 years, it's going to be thousands of dollars more. But if your rate is, even if it's 0.25% higher, you might talk $1 a day, maybe a couple cents a day, depending on the size of your loan. Unless you're talking about millions of dollars, or you run a hedge fund or something like that, fractions of a percent aren't going to save you money. So I've had people in my office, I say, hey, you're borrowing $300,000. Like, yep, this is your payment. I'm like, okay, yep. And this is your rate. Like, yes, oh, that's what I'm talking about. Yeah, they're like high-fiving me. And it's like they didn't even care about how much money they borrowed or anything like that. They just cared about the rate. So you got to focus on the whole picture. And if you're trying to save money, pay that bad boy off earlier, or put a little more down potentially if you're going to stay there. Just you got to look at the whole picture. And one of the reasons why I bring that up is because if you guys are following the news at all, rates are going up and they're not going down. This is a formula in case you care about how your rate is formulated: amount, principal, like I said, the amount you borrow, interest rate, time, compounded number, and that's usually 360 or 180, just depending on whether you get a 30 or 15 year. I'm not gonna bore you all with that. All right, pretty much at the end in closing. So we're gonna get to closing, which is kind of the fun part. But closings, they're not really that exciting per se. Nobody's juggling or anything, but it is exciting in the sense of, you bought your house, you officially own it now. Seller is now released of their ownership, buyer now has it. Closing costs, really important when talking about a closing. So closing costs are going to be determined by who your attorney is. They're going to put fees to close the loan because they do a lot of work involved with it. Your insurance, that's going to play into it. Your taxes are going to play into it. Your lender fees, your appraisal, a lot of the stuff that we went over, it's all going to play into it when you buy the house, and that's part of your closing costs. And normally it's a percentage of the loan, so it could easily be 3 or 4% of the purchase price. So if you buy a $200,000 house, it could be $6,000 to $8,000 in closing costs. That's just because they're not frictionless transactions. There's costs associated with it. So really important how much closing costs the seller's going to pay, how much you got to come out of pocket, because it can equal your down payment if you have it, which you might or you might not have. Okay, sometimes seller pays, sometimes borrower pays, sometimes the lender will pay for some closing costs. Closings normally happen at attorney's offices, and the buyer brings a certified check. It can't just be a personal check for $10,000 or $5,000. It has to be a certified check, or you can wire the funds, but attorneys are getting a little bit sketchy about that because there's a lot of cybersecurity. So certified check is kind of the way to go. And then the bank wires the rest of the funds, however much it is. And there's a ton of paperwork at a closing. It's just signing date and over and over again, over and over again. So, but it's an exciting time. All right, so just to close, some additional points I felt like I had to include in this presentation because it wouldn't be right if I didn't. Mortgage compliance. There's a 3-day rule called TRID. And just to show you how just crazy convoluted it's gotten, TRID is actually 2 acronyms within an acronym. So the T stands for TILA, which is Truth in Lending Act. The R stands for RESPA, which is the Real Estate Settlement Procedures Act, and then Integrated Disclosures. So in that TRID, there's two more acronyms in TRID. But basically what it means is after a lender pulls your credit, they have 30 days to decide whether or not you're approved or not approved. Not really approved, not approved, but if you're declined or not declined is more accurate. If you're not declined, within 3 days they have to give you a bunch of disclosures telling you about your credit score, about your rights and all your protections and all the fees that might be associated with your loan. And that's all well and good, but the most important thing about TRID is before you close, 3 days before you close, 3 business days, they have to get you what's called a closing disclosure. And that it details all of your final numbers for you to close. So if you don't get that, you can't close. And you have to prove that you received it by either signing it or opening it or whatever, but you have to prove that. So if you don't do it, you don't close when you're supposed to. 3 business days, so it's really important. Oh, and loan programs. Not gonna really get into that because this presentation was just about broad strokes. But I just wanted to make a point that there's plenty of loan programs out there that we could be here for 2 hours. There's USDA, VA, FHA, there's ARMS, there's specialty loans, there's all kinds of things that we could talk about. We're not gonna talk about that, but I just wanted to let you guys know that what I gave you today is kind of the broad strokes, and there's a lot of loan programs out there. All right, that's it. So, any questions? Any questions at all?
Yeah, so like in our situation where I just got out of school and now I'm making, income that I never made before, you said we have to have 2 years of proven income. Kind of what are we looking at with that as far on y'all's end of, proving that income or whatever y'all want from us?
So are you on a salary?
I have a salary and commission.
Okay. So the easiest way to do it is to get a verified letter, like an employment contract. And if it says, hey, he makes XYZ amount, this is how he's paid commission, and he's guaranteed this amount, we would use the guaranteed amount.
Okay.
If you don't have any guarantees, it's going to be harder. Things can usually be worked around, but for your specific situation, we have actually a professional loan. So it's actually an in-house loan. So if they just say, hey, can we prove how much he's going to make, you can qualify for it. But as far as proving your actual income, we need to have something written, some pay stubs, tax returns, just like normal.
Okay.
Yes, sir.
Appraisals. Speak a little bit about appraisals.
Okay, yeah. Did you get a copy of the appraisal? Did you get to look at it?
No, what does it mean when you're buying or selling?
Okay. So the appraisal is when the appraiser, let's say that it's you would go and appraise a house, and let's say it's this roof, okay? You would walk in and then you would say, okay, I'm gonna look at all the similar rooms in the area that have sold in preferably the last 6 months. Let's say that room next door sold for $100,000. You say, okay, this is pretty similar, so this one should go for about $100,000 also. It's based on the market. It's based on past sales and recent sales.
Okay.
There's a lot of pictures they take. They're not just walking in and saying, oh, 300,000. They're looking at everything that's sold in the past.
I just had a question about fixed versus ARMs. When you get a loan, that's either on a fixed rate or on an ARM. An ARM is a program, whereas a fixed rate is like a standard. I didn't understand.
Yeah, so we didn't really get into that too much. That's a good question. An ARM, it stands for adjustable rate mortgage. So if it's an adjustable mortgage, it's usually fixed for a certain amount of time, 5 years, 7 years, 3 years, however long. And then after that, it starts to adjust. Every mortgage is a little different, and it tracks. I don't know how into it you're gonna get, but it'll track an index. So it might be the LIBOR, which is the London bank rate, or it might be the Fed funds rate. Excuse me. And then they attach what's called a margin onto it. So let's say that the LIBOR is 1%, the margin is 2%. Your rate might be 3%. And it adjusts maybe once a year, maybe once a month, maybe once every 6 months. And then your rate will adjust, your payment will adjust. It can either go up or down. Normally there's a cap, meaning you can't go above this amount, which is good, obviously, because your rate could jump from 5 to 9%, right? Or there's a floor, so that it can't go below maybe 2% or something like The advantage of an ARM, which they're really, really dangerous if you just get an ARM, it's not a good idea. But if you have a specific intention, it can be beneficial. I know people who have done well on ARMs, but basically the appeal is that it starts off at a really low rate. So it kind of induces you with the low rate, and then it's gonna switch up on you. And if rates are going down, you might benefit. So it's kind of like gambling, so to speak, but it's fixed for a certain amount of time.
So that, we've talked before about how for like small business owners, it's kind of hard to always really get a good handle on their revenue or income. And so with people that are like reporting a K1, how is that different? And if the business also already has something like an SBA loan or anything like that already applied for, and that they still like owe on, how does that affect the ability to get the mortgage?
That's a really good question. Really good question. So basically taking a step back, self-employed versus not self-employed. The definition of self-employed means you own more than 25% of the business. So if you own less than 25% of the business, you're not self-employed. Okay. So assuming that you do own more than 25%, it becomes a process of separating your personal debts versus the business debts. So let's say you were using business funds for down payment on a house. You would have to prove that that doesn't impact the business, right? So if you get a K1, then you have to count, if it's a loss, you have to count that against you. If it's a profit, you have to add that to your income, okay? So if you have a business loan, SBA loan, and it's on your credit report, that's gonna count against you unless you can prove that only the business pays for that. Usually that's canceled checks for a year or something like that. Or did you show it coming out of a company account? You don't have to count it. If it's coming out of your personal account, then it's gonna count against you. On self-employed people, it is oftentimes very tricky because it's sort of in your best interest to show losses and reduce your income as much as possible. But then when it comes loan time, and then you say, hey, I've actually seen it where a business owner around here showed me his bank statements. $50,000 a month going in the bank statements. But on his tax returns, he makes less than minimum wage. Excuse me. And he had 2 car notes, he had all this other stuff. And his debt to income ratio, which you know what it is now. It was just crazy. So it is kind of tricky. The only way to really know is to see what's on your credit report and counting against you, looking at how you file your taxes and seeing exactly where you kind of diverge from, okay, this is Phil and this is his business. See? That kind of,
Yeah.
okay. It's complicated. It really is complicated. I don't want to make it sound like it's easy, but that's a good question. Well, I appreciate you guys. Hopefully you learned a little something. Hopefully, and if anybody here is looking to buy a house, there's real estate agents in here to kind of help guide you. Henry, he's a master of credit, master of financial literacy. We're doing a couple more events tomorrow, Wednesday. And like I said, we partnered up with the library on a couple of things throughout the summer. So if you guys want to learn some more stuff, come right along. So I appreciate everybody coming out there. Everyone's busy. So thank you.
All right.